Neil, we talk all the time about where we are in this cycle. Is it late cycle? Is it end of cycle? What is your expectation, just again, based on what you're hearing from people and companies in your district?
Well, I think it's a mixed, there's some mixed signals. On one hand, we've got overall pretty healthy U.S. economic growth. The job market just last week put up we're averaging 205,000 jobs a month, which is remarkable this year. If we were really at maximum employment, the U.S. economy should not be creating jobs at that rapid rate. So the job market seems very healthy. Wages are slowly ticking up. That's also good for consumers. It's also a good economic indicator. At the same time, I look at the yield curve. I look at the bond market. The fact that the 10-year, as Joe said earlier, is around 240 this morning says that bond investors, at least, are signaling slower growth in the future. And so I think right now we're getting different signals from different parts of the economy, but the fundamentals of the real economy appear to be quite healthy right now.
Neil, what are you hearing from the inflation numbers that are out there? They're down in the 1.5%, 1.6%, and sort of moving the other way from your target. Do you see this decline in inflation as transitory?
Well, I'm not so much in the transitory camp because it's been pretty consistent for the past 10 years. I think over the past 10 years, core and headline inflation have been averaging 1.6%. Our estimates at the Minneapolis Fed, we look at inflation expectations we think are anchored at around 1.7%. So to me, that is an evidence that our own monetary policy has done that. We've been tightening. We've been raising interest rates when inflation has been below our 2% target. For me, we've been demonstrating that 2% is more of a ceiling than it is a symmetric target. And so I personally think that we need to act as though it's a symmetric target, let inflation continue to build, let it actually go above target for some period of time to demonstrate that we're serious about that symmetry.
But at what point, Neil, when you keep missing your target, does that require a response on the monetary policy side?
Well, it could. There's no question. I mean, if we saw job growth really slowing down, then you might say, well, the U.S. economy is slowing and we're really going to anchor these inflation expectations in at 1.7%. We need to do something. I'm not quite in that camp yet because we continue to see the job market exceed expectations. As you know, Steve, we need about 100,000 jobs a month to keep up with population growth. The U.S. economy is creating 200,000 jobs a month, and wages are slowly picking up. I still think there's slack out there, and as the U.S. economy uses up that slack, more people come into the workforce, we'll see wages climb, and eventually that will pass through to inflation. So I'm not giving up on a long-run Phillips curve story. I just think we've been underestimating how much slack is there.
Neil, I just want to point out that while we've been talking this morning, the futures have taken another leg down. We're now looking at the Dow futures implied down by almost 400 points. Do you think that's an overreaction by the market or not, just based on how the market's trying to figure out what's happening with these China trade talks?
My guess is it's just a lack of news. It's a low information. People are trying to assess it, so you see this kind of volatility. I don't think your viewers, or certainly we, should be paying too much attention to short-term movements like this up and down in the stock market. I think it'll take more time before any of us know where these trade negotiations ultimately are going to end.
Hey, Neil, a separate question, somehow related to where the stock market is. We've been talking a lot about Uber this morning. I wonder whether you think there's a bubble in private market valuations that isn't being accounted for in all of this.
Well, there could be, but I think private market investors are well positioned to take any kind of repricing. And so if they, paid up rounds and then the public markets don't reward them, I think they're in a good position to be able to bear whatever those losses are. So that doesn't give me too much concern.
We should probably break in here, Steve. You want to just read what's going on here? Because this may
the new Reuters headline. Joe, do you got it?
Yeah, China plans to set import tariffs against $60 billion worth of U.S. goods, taking effect on June 1st. It will impose tariffs ranging from 5 to 25% on U.S. goods. That hit about 2 minutes ago.
Looks like that's why the market took another leg down.
I saw it happen and kept trying to click on it. Yeah.
It wasn't Neil's comments. It was.
Yeah.
Well, you're not helping, Kashkari.
Neil, you said you think cooler heads will prevail, but in the meantime, we're going to have to watch every headline that comes out.
We are going to have to watch these headlines, and it's going to be more volatility. And I think Steve said it's very hard to put probabilities around these different possible outcomes, and that's what makes the analysis so difficult. So all of us are somewhat in wait-and-see mode. But I think relative to China, the U.S. is in a very strong position. Not only is our economy bigger, our economy is much less sensitive to trade. Trade is important to the U.S. economy, but it's much more important to the Chinese economy, just as a share of its economy. So if there is a tit-for-tat strategy here, and I'm not advocating it, but a tit-for-tat strategy would seem to lean towards the U.S.'s strength rather than China's strength.
Neel, there was a note out from Morgan Stanley today saying that the FOMC is likely to take fund rates to zero next year if there is even a mild recession. You'll be a voting member on the FOMC next year. Does that sound like a likely scenario?
Well, I hope not. I think that I was more nervous 6 months ago when, the path that the committee was forecasting were continued hikes. I was more nervous about what that monetary policy path would do to the real economy. The fact that the committee has moved and we're now paused, I feel pretty good about where we are. I think we have rates roughly at neutral. And again, if the job market continues to be strong and if GDP continues to be strong, then I'm optimistic that the expansion can continue. The one area that's, well, other than trade, the other area that is really flashing a yellow light is, of course, the bond market with the 10-year where it is. Investors are signaling more cautious economic growth. So that's something I'm paying close attention to. An inversion of the yield curve, I also think, is something we're all paying close attention to. So it's not all green light from here, but I think the fundamentals, at least so far, are strong, and we want to do our part to keep the economy growing.